Hello and good evening, everybody. Good evening, Mike.
Hello, good evening.
All right, awesome. Guys, if you can hear us, can you just say yes on the comment section? Just want to make sure that everybody is able to hear us. Okay.
Okay, I think
All right. Thank you, Luis. Thank you, Lily. Looks like we're all set to go. All right, welcome everybody, and thank you for joining us tonight. So we have Mike Ong with us. Okay, Mike is basically from Philip Securities. He's the senior dealer. He's a member of one of the largest dealing team. Actually, he specializes in the equities, ETFs, CFDs, and bonds, and it manages over 50,000 clients accounts in Philip Securities. So he's going to basically share with us on tonight's topic, right? How you can actually use REITs as an income generating vehicle. All right. So before we start, I just have to go through some disclaimer first, right? Okay, hold on, yeah.
okay, sure.
Okay, so before we start, whatever that's being shared here today is for educational and informational purposes only. It is not intended as any investment advice. All right, so if you want to look for investment advice, please do look for a licensed and professional investment advisor. All right, so basically, Mike is going to do the presentation. If you guys have any questions, you can type it down there on the comment section. Then I can bring these questions to Mike. But Mike will also give us the opportunity to actually ask questions as he presents. All right. So without further ado, Mike, I pass this on to you.
Okay, thank you, Benny. So let me share my screen first.
All right.
Okay, I think most of you should be able to see my screen now.
Okay, yes.
Yeah, so actually I'm from Philip Capital. So I think most of you already know what is Philip Capital poem, so I will skip that. Okay, so just a brief introduction about myself. So actually I started when I study, right? I don't study finance or I actually started and study chemistry, but working in the chemical industry for a few years, and I find that I have passion in finance industry. That's why actually I make a switch over a few years back, and now yeah, I'm doing in finance industry. So for my for what I actually do on a daily purpose, right, is actually we deal with client on a daily purpose with equity, bonds, and different type of investment too. On top of that, actually we do carry out I write article, carry out webinars to educate our client. Also, I do have a Telegram where we do active discussion with our client. So I will begin our webinar.
All right.
Okay, so actually what we are talking today is actually real estate investment trust. I think everyone know about this tool. Is actually so these are the outline that we'll be actually covering today. First of all, we'll cover what is actually real estate investment, then what is actually the fundamental of REITs, and we do some case study and 3 different investment strategy that you can actually use to apply to invest in REITs. So I think everyone actually from the young you actually get exposed to property. So other than buying property, right? Because if you want to buy a physical property, usually will require millions of dollars or even hundred of Ks to actually apply for. And on top of that, you need to actually place a deposit and you need to borrow from the banks. So you actually have continuous financing charges, also called finance charges that you have to pay. However, real estate investment trust give you an opportunity to invest into a portfolio manage of real estate, because usually for real estate investment trust, right, it's actually a collective of property. For example, you are investing in Ascender Street. It's actually a number of properties around Singapore and worldwide. So this one actually give you the opportunity to invest into all these property at a lower cost. Can be even in hundreds or thousands. So in Singapore wise, it's actually very well known for REITs. So we have over 40 REITs from different part of the world. We have actually REITs from UK, US, and also Europe coming to Singapore to list. So you can know that Singapore is actually very popular because of the I would say that because of the infrastructure and also the tax that actually allow shareholders. So actually for shareholders wise, the REITs, right, it's not taxable. So what you get is actually you get a net return rate. So when you invest in all these REITs, right, what is our objective? So first of all, when you actually buy property, you want to do rent out, right? You can actually get rental income. So for this real estate investment trust, also give you the rent income from all this rental income. And sometimes when you buy a property, the price actually go up and you decided to sell. So for REITs wise, they also give you the opportunity to get capital gain from all these profitable sales of this real estate investment assets. So you can see actually REITs is quite similar to actually property. Yeah, and it gives you, but it's easier to invest into REITs as compared to physical property because of the huge cash flow outline. So when you talk about fundamental of risk, we'll look into different type of fundamental of risk. So actually I come out with 9 different factors that I look out for. First is actually different type of sectors. After that, we look into price to book ratio and sponsor, gearing ratio, cost of debt, interest coverage ratio, wills, occupancy rate, and also yields. So first of all, there are many different type of real estate. For example, you can know that actually for healthcare, and there's also risk assets that actually cater for data center or more towards the tourism, hospitality, retail, commercial industry. And now we actually see that there are also a lot of REITs, right? They do not just focus on one individual sector. Sometimes they may range from different sectors. So in Singapore, I'll say that there's actually 2 main healthcare. One is actually the Parkway Life Real Estate, and the next one is actually the inside Indonesia, the First REIT. However, First REIT hasn't been doing well, especially along with the Lipo Karachi. The sponsor is actually a Lipoma group, and the sponsor is actually Lipo Karachi. So when you can see that sponsor is affected, it will affect the REITs that are linked to them. So later we'll talk more about this. Give me a moment. So you can see other than that, actually during this period, right, you can see data center is also one area that we look into, because data center, you know that actually with technology trends, right, especially if Internet of Things, then you also do working from home, you require to store all this data on the cloud server. So all this actually require a lot of data center. The next thing is hospitality. I would say that hospitality will not expect to do well, especially with COVID-19 over the past few years, and we expect them to continue go up over the next few years. You can see actually even in Singapore, Taiwan, and Malaysia, the case actually continue to spike up. So you can see we at one point of time the COVID almost actually we almost remove it, but actually come out back again. So you can see that the potential impact on all this tourism industry. You can see airlines are all this being affected. So next thing is actually retail. We have actually Lipoma Trust in Singapore. We also have other retails. Then commercial is actually a Maple Commercial Trust. It's actually a mixture. Then for industry, we'll talk about Ascenders is also another kind of mixture. So you can see actually different type of sectors, right? You actually perform differently during the economic cycle. Yeah. Okay, so when we also talk about different sectors wise, right, there will be actually some sectors are more sensitive to economic cycle. So especially for tourism, you can see when there's recession, right, we actually tend to cut down on all these luxury traveling, and so this type of sector, right, like hospitality, will be actually affected more. And in case of like healthcare, right, because regardless what happened, healthcare, if you really need, you will still need. So this kind are more defensive and they are less sensitive to economic cycle. So sometimes when you are building a REITs portfolio, right, you may want to actually involve REITs from different type of sector so that you can see in different business cycle, right, they'll actually perform differently. And do think that even in the REITs that are in the same sector, that we are not equally, because they do have different components inside. Later we'll talk about this. So when people actually buy REITs, first of all, you always talk about it's actually price to book ratio. So it's actually a measure of share price against their net asset value. So this is actually how you calculate. So generally, when you say over 1 is overvalued, below 1 is undervalued, but it's not a gauge that we actually should be using to actually gauge whether we should enter into REITs. So one thing is that when you actually compare price to book ratio, right, it varies across different sector. So for those defensive sector, right, they'll tend to have a higher price to book ratio as compared to those sector that are more sensitive to economic cycle. So sometimes the low ratio also can mean that there's some fundamental issue with the REITs. So in that case, if you see REITs, right, it's actually trading at a very low price to book ratio, it doesn't mean that you must straight away go in. Sometimes it's good to understand what is happening to this REIT. Is it really a good opportunity to enter into this REIT? Because I think that one of the example I'll share is actually Lipo Mall Trust. So they operate all these retail mall in Indonesia. And you know that Indonesia has been affected by COVID-19. And over time, right, you can see actually Indonesia so-called currency has also been depreciating against Sing dollars. So in that case, right, and also we can know that Lipo Karachi, right, is the sponsor of Lipo Mall Trust and First REIT. They actually get into some debt issue and they actually have to force to sell some of their existing property and also raise funds. So in that case, indirectly affect all these REITs performance. So you can see actually different sectors wise, they have actually different price to book ratio. So you can see those that are less sensitive to economic cycle, especially we are I would say that it's still towards recovery from the recession stage. You can see actually for healthcare and data center, because of defensive sector, they tend to have a higher price to book ratio as compared to hospitality and retail, right? They are more impacted by the current COVID situation. I can see actually they tend to have a lower price to book ratio. As for industrial and commercial wise, some of them may be affected, some may not. So we need to actually look into what is the fundamental of all this and do not just buy REITs on price to book ratio. So you have to focus on other factors. So another example you can see, even across all the retail, right, you can see actually all these are considered retail REITs, right? They do have different price to book ratio. Like for example, Frasers Center Point is actually doing suburban malls, retail malls that actually cater to the daily needs and essential services. So that's why you can see actually tend to be more resilient as compared to this Lipo Mall Trust, who is Indonesia. Just so I explain the issue behind them. Then there's also Landlist Com Trust. It's also another retail mall. It's more towards a town area, and also they do have property in Italy, Milan. So you can see actually, do think of all the risks inside the same sector are not created equally. You have to see what is actually the fundamental behind all this. So one of the most important when you invest the REITs is actually looking the sponsor, because most of the Singapore REITs wise, they have actually a sponsor. So it's very easy to guess. Sometimes it's very easy to guess what is the sponsor of certain REITs. Like for example, you talk about actually CapitaLand Integrated Commercial Trust. So you straight away know that it's actually CapitaLand. So CapitaLand is actually a very, I would say that a well-known property developer, not just in Singapore, Malaysia. They do have a lot of property development around the world in US and also in China and also Vietnam. So that's why it's very important to have a strong sponsor. So usually sponsor are also the major shareholder of the REITs. So what they do is, because they are major shareholder, right? So what they can do if there's a strong sponsor, they actually start to develop all this property. They can actually sell at a fair value or a low price to all this value property into a portfolio. And this allows actually the risk to actually grow over time, because a lot of people say that risk does not have actually growth factor, but if you really study all these risks, right, they do have actually over time. So one thing is that how we look out for. So we look out for the percentage of this sponsor owned in the particular REIT. So the higher percentage of sponsor owning these REITs, right, the less likelihood they will sell unprofitable at an unreasonable amount to the REIT, because they're holding these REITs themselves. So they will actually sell at a better price also. So usually with a strong sponsor, why? Because for REITs, why, remember we actually use some of these debts gearing ratio to actually have a strong backing. You can actually borrow at a lower interest rate from the banks also. And one thing is that because with a strong sponsor, they also give you the first right of first refusal to all these sponsored assets. So next thing, just now we mentioned about gearing ratio. So when you buy a house, you do not usually only pay a so-called maybe 10% or 20% of a down payment. The rest is actually borrowing from banks. So for REITs wise, it's actually a certain gearing ratio. So it's actually a measure of the debts over their total assets. So higher ratio means that actually higher debts. And in Singapore-wise, we can actually borrow up to 50% of the total asset value. And we actually see that this one is similar in Malaysia. Do take note that for REITs in different parts of the world, right, there are some of their gearing ratio or different requirement, right, they may be a bit different also. So you need to think of this. So one thing is that other than gearing ratio, like sometimes it's also good to look out for what is their interest rates hedged, because especially we know that in the short term wise we expect interest rate to go up. Especially we know that Fed has announced their intention that maybe next year onwards they will start to look into all these interest rate. So for REITs wise, they are actually affected by all these borrowing costs. So it's important for these REITs, right, to have hedge out all their interest rates. So you can see over here, we also do look up how much of their debts is actually hedging. So we also look at over interest rate environment. If interest rate is actually environment is actually going downwards, why we prefer those REITs, right, don't hedge out. We can actually borrow at a lower cost. However, in case this and interest rate environment is actually going up, we prefer them to actually hedge most of their debts. So that's what you think about all this interest financing. So we also want to know how much they are refinancing. So it's actually an effective rate that a company pay on their current existing debts. So it determines how capability of this company to pay interest out of their interest debt. So when let's say you are going to buy a property, you always go to different bank or which one can actually give me the lowest financing costs. So same for this all these REITs, right? We actually prefer this risk manager, right, to help us to find the best deal as low as possible for all these costs of debt. So there's different, that's what I mentioned, there's different type. One is fixed. Fixed means, let's say I have a fixed interest rate maybe at 2% for the next few years. Floating rates means that maybe I have borrow at maybe a 0.5% above SIBOR, above the Fed interest rate. So they are fixed and floating. So this is actually how we calculate this. So in general, right, lower ratio is always better. We want to actually borrow at low cost and finance at a lower cost. So one thing you just mentioned is very important to take note of the interest rate environment, especially when interest rate environment is expected to gearing ratio, right? Actually, Singapore-wise, you also implement this called interest coverage ratio. So it actually determines the capability of this company to pay interest on the outstanding debts. This is a ratio that is very important for, especially if you are invest into corporate bonds, right? You want to determine whether the company is able to pay on all this coupon back to the bondholders. That's why this is another interest ratio that can be used in this way. So this is actually how you really calculate earning before interest and tax expenses. So in general, right, if ratio is less than 1, means the company is not generating sufficient revenue for their interest expenses. Next thing you'll be wondering, are they able to actually pay for all this dividend? So Singapore-wise MAS and the government, they have actually set a requirement to meet this ratio 2.5 by 2022. So one thing is that we also do analyze all these ratio over time. Let's say if a company, right, at first their interest coverage ratio is 10, then they deteriorate next year 5, then they rate to 3, then 2, 1, then you know that actually this risk manager, they are not actually managing this company well. In that case, you maybe want to actually avoid this risk rate. So here is actually the interest coverage ratio. You can see actually for all of these interest coverage ratio, right, I would say that those that are well managed, right, generally you can see their numbers is 20, 30, then, but especially for hospitality, right, you can see their earnings has been actually impacted. So their interest coverage ratio, right, currently is actually a bit low and it's already fall below the 2.5 requirement. Then, and they need to meet this requirement. Let's say it's now 2022. In case they are actually not able to meet this requirement, they can actually be revoked of their REITs status. This means that they are so-called the dividend, all this will be taxable. Or another way is that company have to do a certain way to actually raise equity to actually cover some of these existing debts and lower down their debts so that they have interest expenses to actually meet this requirement. So this is something that have to take note, especially going towards 2022, where the requirement for Singapore is to meet this 2.5. Next thing is that wills. So it's actually a weighted average lease expire. So it's actually measure a portfolio risk of going vacant. So in general, right, longer views means more stability. Let's say you have so-called assets that have actually 3 years and 2 years. So with 3 years means that there'll be more stability because people have already signed contract with you for the next year on the whole. So sometimes also shorter views may have also higher cost because let's say you have actually so-called property that have very short view, then in that case, you every few 1 to 2 years, you have to renegotiate all these term and condition, and you have to re-advertise. If in case they actually choose to move to another location, re-advertise this, and they're signing up all these new contracts, right? There'll be actually legal fee. So that's why longer views actually mean more stability. However, sometimes shorter views has also their advantage. Let's say the demand is higher than the supply. So in that case, actually, with shorter wheels, the risk manager, right, they actually can negotiate with the tenders. Hey, I'm going to increase your rental. Do you still want to rent? Because if they are not able to actually find space to rent outside, in that case, they have to continue to rent. So that's why it's actually, I would say that you need to also look at the overall property supply and demand. Usually, a good risk manager, right, they're able to actually manage all this. Next thing is that occupancy rates, when you actually it's a ratio of how much space is actually rented as compared to the available space. So when we actually compare this, right, we always compare with the past number. This one will actually reflect the management ability to secure their tenders. So in this case, right, usually we prefer a number above 90% or as much as possible. We want 100% because when we mean 100%, right, means that we are getting the full rental income. So this means that higher dividend also. So we always look out for high and improving occupancy rates. So other than this, right, we also look out for what we call anchor tenant. So in shopping malls wise, it's actually more prominent because usually what you call is like a draw or tenant or the key tenant. In Singapore, we have so-called supermarket. Supermarket are usually the one of the anchor tenant because they are able to actually draw crowd because everyone come here to actually purchase their grocery. So I think in Malaysia wise, they also have a giant and also different key draw tenants or anchor tenants. So one thing is that about all these anchor tenants, right? Usually they actually occupy a significant portion of this property. You see, supermarket wise, they may take up 10-20% of this whole property. So in case they actually sign to choose not to renew a contract and choose to leave, right? In that case, it's not so easy to actually find another tenant to straight away enter and take over this space as compared to a small space, small retail store. And also a well-established anchor tenants is also very important indicators. So that's why if anchor tenant sign choose to leave, right, it's not easy to find replacement. You may want to reconsider how well actually the risk manager is managing. So some of the well-known anchor tenants you can see McDonald's in because we only talk about all this in terms of the retail space because it's more able to relate to us. In terms of commercial wise, we are not really able to relate more. So for my example, I will just choose mainly the retail sector. Starbucks is also another important, I would say that anchor tenants because you see in a good shopping mall wise, right, you will actually expect to see McDonald's and Starbucks. So the last thing is that when you invest into so-called REITs, right, we actually want to get dividend, we want passive income. So what we look out for is actually dividend payout. So for REITs wise, unlike other stock, right, because other stock they may not be required to have a requirement to pay out how much they actually intend of their income. However, for REITs wise, they actually requirement to distribute at least 90% of their taxable income. So usually what you calculate is actually distribution per unit or yields where we known as percentage. So different REITs they actually pay out differently. Some of them may be pay out quarterly, some may be actually semi-annually. So the timing of all these dividend payment wise is also different. So this is actually how we calculate. So you can see actually the dividend yields for all these different REITs. So some of them as for those more defensive because of their price movement actually have go up, right? You can see actually their dividend wise is actually lower. And also for some others, right, you can see generally just mentioned around 3 to 7%. And sometimes is when you look out for some REITs, right, they may be paying 10% plus. Like for example, a few years ago, you can look at Lipo Mall Trust, they are actually paying out dividend of around 10%. However, you can see actually with all these dividend payout, right, even with the share price deterioration wise, right, they're not able to actually affect, because that's why you can see that dividend payout, although we like high dividend, we must know that it's actually sustainable or not. So that's why it comes to the question, is this sustainable? So that's why you also need to look into factor of all these risk manager, how well they are also managing all these risks. And sometimes we also need to know that any circumstances that REITs may not be able to pay out dividend. You know that actually especially for last year during the lockdown period, all these a lot of businesses, shop house, all these are actually being closed. So they actually have a rental, so-called they do not collect rental for that few months or a few weeks. In that case, because REITs are not actually getting rental income, they may not actually pay out dividend also. So that's why you just mentioned, sometimes it's good to have REITs over a different sector, because some sector they like especially healthcare, also data center, they actually continue to operate. So you continue to generate rental income also. And also another thing is that sometimes right, you need to think note of how they actually collect their rental. And sometimes for sponsor wise, they actually may inject a new asset into property into this REITs. So when they're actually generating all these new asset into the REITs, right, they may not be actually, for example, because you are new mall, let's say a new mall, and you want to get people to rent from this location. So what you do, you actually give some sort of rental rebate. Oh, I give you 10% discount. You rent for me for the next few years. So and usually these are below the market rates. So in that case, actually when sponsor want to sell so-called this property, inject into the REITs, right? You usually do a so-called sponsor top up, where they actually top up for this 10% differences, and they'll top up for maybe first 3 years. And after that, the first 3 years, right, they'll go back. So the tenant is still renting at 90% of the market rate. So in that case, the risk manager will have to renegotiate whether they are able to renegotiate back to the 100% of the market rate. If they are not, then you will suddenly see, hey, how come my dividends suddenly have a huge drop? And also, you do think that because when we actually have REITs that actually have overseas exposure, some of them may have property in, like for example, Ascenders, they do have property in Singapore, US, and also different part of the world. And we need to think of how they actually collect their rental. Let's say they are actually collecting in USD. So in case USD actually deteriorates against Sing dollar, then that means that actually your income will also be lower. So that's very important for a risk manager to do against whether how they are hedging out all these kind of different forex risk also. Just want to mention income support from the sponsor, especially for new assets. So summary of this. First, we actually prefer low gearing ratio, because with lower debts, right, they actually give them more ability to actually acquire asset when there's actually opportunity arise from the sponsor or even outside. Because for REITs, right, they do not just want to get property for a sponsor. In case there's another property developer selling this asset at an attractive price, they can also do acquisition and help these REITs to grow over time. So low cost of debt, I think everyone know, because you want to buy, when you buy property or buy anything, you want to pay as low as possible financing costs. Then high interest coverage ratio means that they are able to actually sustain their interest payout, and they are able to sustain this dividend payout. And long wheels means more stability, and also we prefer actually high and improving occupancy rates, especially above 90%, or if possible 100%, means that we are getting almost everything from the rental income rate. And high and stable yield, high and stable and sustainable yield. You do not want to be high, but it's not sustainable. You see maybe you get high dividend yield, but the share price continue to deteriorate, then end up we actually getting a negative returns. So now we actually use what we actually learned just now, we put into some case study. So for my example, once I actually selected Frasers Logistics and Commercial Trust. So this one is one of the REITs that actually do a presentation of their so-called financial report recently. So when you actually see all this, right, they provide a lot of information. So what we actually look out for, first of all, that's what I mentioned, occupancy rates. So you can see actually for this, right, they actually have 96.8% of their occupancy rate being rented out. So this means that actually risk manager are actually managing quite well. With all this being managed well, right, that means that actually higher rental income and higher possible the dividends payout. Next thing is that they actually have 35.3% of their gearing ratio. So they can actually make use of some of their debts, right? Because the limit is actually 50%. So you can actually make use of this debt. Let's say, oh, there's another property now selling at a discount. They can actually create the opportunity to do acquisition. And recently, this Fraser Logistics and Commercial Trust, they're actually doing acquisition to help these REITs to continue to grow. So when REITs actually do acquisition, right, some they can actually do in a few different methods. One is actually using make use of this gearing ratio using debts, or they actually can do equity raising. So equity raising wise, they can actually do a preference offering where they actually offer to all these existing shareholders. Rights issue means that anyone is who are holding these rights, they are entitled to so-called subscribe to this REITs, and also private placement. This means that actually offer to certain institute player. So usually we don't really like private placement because for existing shareholder we miss out this opportunity. So this is something that's out of this today webinar, just to share more information. So next thing is that just I mentioned gearing ratio. Their cost of debt right is actually 1.9%. So we actually want them to actually borrow as low as possible, and also look out for their real average debt maturity. You can see actually over the next few years how their debt profile is maturing, and whether actually they are doing hedging out their risk or this, and how they are borrowing, whether is it in Sing, Aussie, pound, euro. So you can see actually they also borrow in different costs because they have property over the different part of the world. Next thing is how much percentage is in fixed rates. So 70.6%. You know that interest rate environment is actually going up. It's better to actually hedge out most of their borrowing at the fixed rate. And also their interest cover ratio will meet the 2.5 times requirement of the regulation. So you can see their overall risk management interest rate portfolio. So you can see actually in Singapore, Australia, Europe, and UK, right? You can see actually Australia make up most of their actually portfolio and where they are borrowing is from. So they tell you all this kind of information that we need to look out for. And how actually their property breakdown. So you can see actually this one is not just in logistic. They are actually more not logistic. I would say that it's considered part of industrial sector. So you can see actually there's logistic and commercial trust, commercial side of the business. So you can see that actually they do have offices, business park, and also commercial, and also they do have logistic and industrial. So you can see all these different matrix and how much is actually in logistic and industrial. And actually, you can see actually commercial side in the business as they actually dragging down a bit of their overall portfolio in terms of the occupancy rate, because we know that actually when people actually start to work from home, you can see you heard a lot about banks and also different company, right? They cut down office space in the uh, CBD area. So when all this we cut down in terms of their space, right, all these commercial sectors will be actually affected. So you can see how their lease expire, whether they are actually managing out all these lease expire and renegotiating for their rental revision. So one thing is that we also look out for rental revision. Refer to risk manager, right? A strong risk manager who are able to actually manage out the demand and supply and actually do positive rental revision. Because when positive rental revision means that your dividend will actually be increasing over time because rental is also increasing. So they also do breakdown of the all these tenants. We do not want them to actually have a concentrated risk of in certain sectors or certain businesses, because in that case, if that part of the business is actually really affected, then will affect the REITs very significantly. So they also look out for how they're actually managing all these different situations, whether is it Australia, Singapore, and Europe, how all these management are managed, especially in this COVID situation. It's very actually affecting a lot of businesses. Then what is the objective? So we look out for all these different, just to make use of all these factors, right? You also look out what is the objectives. So actually, we'll come to one question. Just now people ask, interest rate is actually going up. Is it really a good time to invest into REITs now? So actually, one thing is that when you're actually building a before you do any investment, right, I will say that you need to actually set up your investment goal and objectives. So are you creating a passive income? And I will say that most of us actually come today, we want to actually use REITs as a income generator vehicle, means that actually want to generate passive income. So is it a good time to invest? First of all, actually we also look at the overall market ability look into the managed REITs manager ability to actually increase rental. So you can see just now I mentioned rental revision. So you look to all these REITs manager record wise whether they're actually able to do so-called positive rental income over the years. So how they are actually able to do all this positive rental revision, right? Is actually mainly looking out for the market demand and supply, and also whether they have actually a strong, good location. So with a good location wise, they're actually able to pass all these costs to the tenants. So people actually, businesses wise, actually choose to prefer rent space in where there's crowd flow, especially for the retail businesses. And for offices wise in CBD, we want also close to the transport hub, transport MRT that we call in Singapore. And also we look out for any rental expiry date, expiry because we do not want REITs right. No, they have actually 100% of their rental expiry in this year. In that case, they'll actually have a hard time to actually renegotiate with each different tenders. So we look out in all this ability. And also gearing ratio, just now mentioned, let's say opportunity arise. I cannot do equity raising straight away. I maybe have make use of this debts and actually acquire this asset first. Subsequent, I'll see how I actually do equity raising. So this gearing ratio actually has be a good ability of the risk to acquire assets. And interest rate financing, just as I mentioned, especially interest rate financing is actually interest rate environment is going up. So one actually all these REITs right prefer most of their debt in fixed borrowing, means that they are not affected significantly by all these raising costs. And also method of financing. So for REITs wise, they have actually different type of financing. They can actually borrow from the bank, borrow from the institute, and some REITs right they also do issue corporate bonds to do borrowing. So you can see with a good sponsor is very important. They help them tap on of their reputation and borrow at a lower cost. So you can see the cost of financing, also their debt maturity. They are actually how they are managing their debt mature over the next few years. So we come back to COVID-19. So it affect all these different sector differently. So we look out for each different individual sector of outlook. For hospitality wise, we know that lockdown and travel restriction will continue at least for the next few quarter or even years, because you can see even with actually the vaccine, right, it doesn't really help the overall situation. You can see actually there's virus mutation against the vaccine. So you can see hospitality wise will be continue to be affected significantly. And you just see Singapore SIA alone. Last year they are actually doing equity raising and do debt raising, and just this year wise they have to do debt raising because it's really not sustainable for the businesses. So you can see all this tourism right will be affected unless you have actually local tourism cater to the local, means that internal country travel. So in that case, I would say that in Singapore wise we don't have that, but in China wise you can see in the recent golden holiday they have actually start to resolve the issue of this COVID-19, and they actually have internal local tourism where actually they can travel among different provinces, right? So you can see actually for that case, in that tourism area, it won't be affected. But if you are talking about global tourism, it will be continue to affect. And also travel of businesses. Last time when we actually went down to give webinar, last time I actually went down to Malaysia to give a seminar before. I went down to Brunei to give seminar. But now I'm actually stuck in Singapore. I can't actually travel. So you can see actually business travel actually make up a very significant portion of this tourism, because for business travel they are able to actually pay for it, so they actually tend to make out a single portion. That's why now if with this all this lockdown and traveling restriction, like company actually restructure to work using Zoom, also all these online services, right? So in that case, there will be actually significant cut down in the business travel. Next thing is about retail. So you can see actually there's closure of some non-essential trades. So when you talk about retail, right, there's actually essential and non-essential. Essential, what you consider is we require on maybe a daily routine like grocery, F&B. However, there's fashion, all this, we do not actually consider them under essential. So there'll be some non-essential trade being closed down during this period. And also, there's also a lot lockdown and travel restriction. Like for example, I think in Malaysia, wise you all can't travel actually, go out to how to meet friends or this. So there will be a lot lockdown and travel. And in Singapore, wise, most of us will be actually working from home, and we also have so-called a criteria of maximum 2 person in the group to go out. So you can see all this, right, will actually affected all these non-neighborhood malls. And also next thing is that with all this lockdown, right, everyone start to learn on where to do shopping. Online shopping, Shopee, we have actually Lazada, we have Q10, all this, you can actually do shopping online. So and last time everyone is actually a bit so-called facing resistance to do online shopping, but now you can see with this COVID-19, it has actually changed everyone's shopping habit to online. So this will definitely affect some of these retail malls, retail space, and how they are actually going to cope. And also cinema, you can see that all this they are not able to actually cope. Last time you can maybe hold 200-300 in a cinema hall, but now it's maximum only 50. So you can see actually there's very significant impact on their income also. This will actually affect the rental for all this retail space. And also work from home. So you know that in the commercial side, when work from home, they'll be cut down offices. Lastly, industrial. So just like I mentioned, data center will expect to do well because everyone is actually making use of all these technology trend, cloud services, Internet of Things, 5G, all this will require a lot of data center. So we expect them to actually do. One thing is that we also talk about the internet economy. So all this online shopping, Grab delivery, digital bank is what we call actually internet economy. And we expect internet economy for Southeast Asia, right, to grow over this next few years also. Especially Temasek and also Google, right, they did this study on the internet economy, especially in Southeast Asia. We just talk about bank. It's, in Indonesia, there's a few thousand islands of. Is it possible to really build bank on each different island? It's not possible. That's why actually that's the potential of all these digital banks. They will help to capture all these unbanked people in the world and in different part of the island. So that's why digital bank will actually create a very significant impact in the internet economy over the next few years. Next thing is that when we actually do all this online shopping, like logistics will continue to grow. You can see actually logistics sector has been actually benefiting over the past I would say that past few months or few quarters. You can see actually that's why just now we also talk about Frasers Logistics and Commercial Source. They are one of the key players in all this logistics space. However, do take note that there may be potential slowdown in certain industries because of due to the change of technology, right? Maybe some industry, right, they will be actually no longer needed or their technology is outdated. Then we actually shift, especially in the semiconductor industry. You know that actually all these microchips, all this, they move move very fast, and technology get outdated very easily. So that's why industry-wise, logistics and data center will continue to do well, but for certain industry, they may not do well. So here is actually an example of the Singapore REITs under the Philip research team. So they do have actually a so-called accumulate and buy call on all these REITs that you can actually keep a lookout for. In case you want to actually find out more about this stock report, right, you can actually visit the stockbnb.com. They try to actually follow the airbnb.com. So they come out with the stock BNB. So you all take a photo or screenshot of this. I think most of you will be actually interested to see this.
Mike,
yeah.
What's the difference between accumulate and buy?
I would say that actually they do, when you actually read the report, right, I would say that one of them is actually a stronger call. Later, I will show you the exact reports towards the where to actually go to visit this website. You can understand about this buy and accumulate.
Right.
They do have each individual report, right? They do have summarized what is the key point of all these different REITs. So later, I think everyone will ask this. So later, actually, I cover inside the demo. Okay, let me see. Continue. Okay, I think you still have the strategy portion.
Okay.
So actually, there's a few different. Sometimes it's very hard for us to predict what is the top and bottom. So that's why we actually come up with the dollar cost averaging. And also there's actually value averaging. And lastly, you have actually the price to book averaging. So I think everyone understand dollar cost averaging. So before you actually even go into dollar cost averaging, you must understand the fundamental of this target stock. You can actually use it for any stock, not just REITs. If the fundamental actually remains strong and sound, you can actually do dollar cost. But in case the fundamental start to deteriorate, it's time to actually cut loss. So it's actually putting a fixed sum of money on a regular basis to purchase a shares. So it's regardless of share price. Share price low, you purchase more. High, you purchase less. Because for this passive income, right, we actually hope to build a so-called portfolio that can actually generate sufficient passive income that we can actually retire. We don't need to work anymore. And then I do know that actually there are some Malaysian clients, right, actually they started in actually 2000. They actually built up a very significant portfolio with Philip Securities, and now their passive income per month is actually in terms of, I would say that per year, right, in terms of 6 digit Sing dollars, and they're actually more of that's because they actually do a dollar cost and passive dollar cost every to build this portfolio over the past 10 years. After that, they do not need to build anymore, and they start to actually do retire. So they have actually a plan, structure, strategy to slowly build all this portfolio. So I think this is an example on how you do dollar cost averaging. You just put in fixed amount of 2,500 per month. Let's say your intention. So first quarter, maybe you buy with this amount, share price 2.13, buy 1,174. Second month, share price go up, so you buy a bit lesser share, 1,136. Third month, well, when share price actually dropped to 1.9, then you can actually buy more shares. So this is actually they do dollar cost averaging over the past. So you can see over this period, right? Let's say you do dollar cost averaging. Your average cost price is actually 2.15, but actually the share price is actually at 2.27. So you can see actually how much you do earn over time also, other than the dividend. So people always ask whether is there a better strategy than dollar cost averaging. I'll use this example. Soap bar. So I think every household will require soap bar. So let's say one soap bar is $2 per quarter. Maybe your mom will only buy 4 soap bar per quarter. However, you see, supermarket suddenly have a big discount. What will do? It's $1. What your mom and most people will do? Straight away buy more. You buy instead of buy 4, maybe you buy 8, you buy 10. You start to actually stock up because it's like a discount as long as there's no expiry date. Then after that, when actually share price that, but you can actually this quarter will increase to 2.5. But the previous quarter I bought a lot, I stock up already, so I don't need to buy so much already. You can see actually the differences. So this is actually a strategy called value averaging. So first thing, regardless of any strategy, understand fundamental of the stock, target stock. This time right, we also set, instead of amount to book, right, we set target investment value to accumulate per quarter. Same thing with share price low, purchase more. Share price high, purchase less. But it seems quite similar to dollar cost averaging. So how we can actually see the differences? This one actually require more time and effort from the investor. So let's go to example. So using the same example, you can see actually the calculation wise is actually a bit different. You set target investment value minus the actual value of your shareholding divided by the share price. So your target investment goal is actually to increase 2,500 per quarter. So let's say first quarter wise, no different. 2.13, you purchase 1,174. Second quarter, actually share price go up. So you can see actually your existing so-called portfolio, right, it also increased in terms of value. It's no longer 2,500. It's slightly more than 2,500. So to meet your target investment goal of 5,000, right, you just need to invest 2,418. However, when actually share price low, right, you need to actually put a bit more to invest. So just now you can see actually there's the average cost price that is actually a bit slightly lower because using this value averaging strategy. So maybe you do a comparison side by side easier. So you can see using dollar cost averaging, your total gain plus your dividend wise over this 2.5 years from 2016 to 2018, right, is actually around 12.19%. However, value averaging is around 13.13%. So value averaging actually performs slightly better than dollar cost averaging. And you do think that actually during this period, right, the price drawdown of this, right, you can see the difference between from the highest 2.27 to 1.9, right, the difference is actually very, very small. You can see this strategy value averaging actually outperformed dollar cost slightly a bit. However, you sometimes can see very, very volatile period. Let's say we take about example of 2008 to 2010. You can see at one point, wow, this share price of this Fraser Center Point dropped all the way from 1.46 to 0.63. For most people, right, when they are timing market, right, wow, when they see the share price actually drop significantly, they won't be actually uh, they'll be afraid to enter. However, during that period, actually, the business are still doing well, so they actually continue to collect rental over that period. In that case, right, where actually when you enter over here, there's opportunity. However, because of the fear factor in most people, right, they are not able to actually time where is the best time to enter. That's where we come up with so-called dollar cost and value averaging to actually do enter into market. So you can see if you use dollar cost averaging over this period, you can get a gain of on a total dividend price gain, right, is around 45% over this volatile period. In case you are using so-called value averaging, right, actually the gain is actually 70.96%. Because when the share price is low, right, you need to actually meet this so-called shortfall. You put in much more money. When share price actually start to go up, you can actually technically you are doing nothing over here. You do not need to purchase. So you have to determine whether you are going to do dollar cost or value averaging, because dollar cost or you can know how much amount you need to put every month is fixed. But for value averaging, or sometimes you need to actually come up with more capital first. After that, then when the actual share price start to remain to normal, then you actually do not need to put anything more. So that's actually the main difference between this. So this one actually for value averaging, right, it allow you to time a bit, put in a bit of timing the bottom factor, because and when the share price is lower, as long as the fundamental actually remains sound, you put in a bit more. So that's why you can see value averaging actually outperform the dollar cost averaging by a huge margin when actually the market is very, very volatile. Oh, I think I'll repeat. Okay. So last strategy I'll talk about is actually price to book averaging. This one will be a bit more, I would say that require more time and effort from the investor. So first thing, fundamental of the stock is always the most important before you invest into any stock. So please take note. So same thing, you set target investment value to accumulate per quarter. Then you need to actually study the price to book ratio trend over the previous historical and set a plan to buy. So let's say this is actually a price to book ratio of this Fraser Center Point quarterly from 2011 to 2020. So actually I can calculate, okay, we set our investment goal. So I actually can calculate the standard deviation. So standard deviation, you can set standard deviation of plus minus 1. So one thing is that how after that we determine how to invest. So between standard deviation, if it's between 1, right, you set an investment amount maybe 2,500. However, when actually standard deviation is actually above 2, right, then in that case, maybe you do not want to invest at that point because it's actually overvalued already. Then you expect actually the price to book ratio start to correct over time. So you hold on to any investment. However, in case the actual price to book ratio, right, is below this standard deviation of 2, then maybe you can actually increase your amount. Let's say now is opportunity, I will put in more amount. So you can see actually recently, last year and recently, right, this actually price to book ratio has actually dropped below the 0.9 threshold. So that will be as long as the fundamental of this company stock still remains sound, you can actually put this increase and invest more. So this one also put in a bit of so-called trying to time the market, but we still constantly invest over time. And when market is high, then we don't do any purchase. So this is actually how you can do that. Just need to study the quarterly price to book ratio and do on a standard deviation. Actually, you can do this easily with the Excel sheet. They help you. You just calculate using an Excel formula. They help you to calculate, put in all this data. So advantage and disadvantage of all this method. Dollar cost averaging totally don't have any time factor and do not require large sum of money to invest, less time and effort, just do constantly every month. But one thing is that always take note of the fundamental of the stock. I also do take note because you may know sometimes it's not advisable to do monthly. you have to see how much is your capital, because when you place a trade, there'll be commission. So that's why you need to think of a commission sale charges. So sometimes maybe do quarterly, or maybe once every 4 months is also advisable. So you have to see how much amount you put in also. Value averaging, it's hard to time market, but they include a bit of timing of the factors, and limitation wise, you need to spend a bit more time and effort. Fundamental of the market stock always remain. This one, price to book, you really need a lot. I would say that this one need more effort compared to value averaging, because you need to study the historical price to book ratio. So just to highlight a bit of our Point platform, we have actually been the largest market shares for retail investor. We have the largest network of investor center in Singapore, and we are also one of the largest CFD provider. Then in case you actually want to open an account, right, you actually can do funds transfer using to the our bank in Malaysia. Then we have actually different multi-currency. So each different account, right, we have actually a dedicated equity specialist that actually help you to provide advisory in case you need. So we have actually a very attractive rates in terms of the trading shares. You can trade in case you are actually trading Singapore REITs, right? You can actually trade as low as 0.08%, no minimum commission. And in case USD shares, right, you can trade as low from USD 1.8 onwards. So you can see all this, right, is actually attractive. In case you want to find out, scan this QR code to open the Cash Plus account. I'll leave for, in case you want, you also can visit to find out more. So in this webinars, right, just take note, in case you have, just now as the disclaimer as it has explained just now, in case you need any further advisory on existing portfolio, or you want to buy certain stock, you need more advisory, right, can actually find out more from your trading representative. So in case you want to ask me, you just can drop me an email. This is my personal email at Philip, or give us a call in case our dealing need to call any dealing team. So this is actually the details. So I think I have come towards the end of the webinar. So before that, I show you some useful website link for your REITs journey. I think that's, give me a moment. Let me open up. Okay, so actually for this, right, you can see actually in case you actually invest into SGX REITs, right, you can actually visit securities. Then you can see products. Okay, products. So they actually do have REITs, and they do have actually monthly report on the REITs that you can take a look to understand more. And in case you want to find out specific REITs, right, because just now I talk about all this ratio. So where to get all this ratio from? Give me a moment. How is loading? A bit slow. Okay, because I think their website is taking a bit slow at the moment. In case you want to write later, you can actually come visit www.sgx website. Over here, you can just key in, then you just in over here. Then you should be able to actually find out the ratio over here. See what happened. Okay, maybe I'll go to other useful website first, then I'll come back to see whether this one is out. So just now I mentioned actually there's actually a stock BNB website where we actually the research analyst Reits, right? They do I think maybe I can't give me a moment.
Yeah, Mike, I think because you are streaming live, that's why the internet gets a little bit slow. I'm also
you
getting
can
a
search analyst of the doesn't seem to work. Then the next thing is actually share investor group. So they actually do have a list of all these different REITs, right? All these using Alphabet, you can actually find out more information about REITs over here. And lastly will be actually the REITs weeks. I think this one is also taking a while to load. This one, all these 4 useful websites, right? You can actually find out about all this REITs information. So all these websites you can make use of them. So maybe we can come to the Q&A portion. Whether do they have any question?
okay.
Okay.
Maybe you want to go back to your
Someone asked,
slides. Just now is
yeah.
Ao Yong is asking your contact.
Yeah, the contacts my contacts email you can find out over here. Okay, in case you want to join us to discuss actively, because I manage a Telegram group. I think over there's around 2,000 plus. Where in case client have any it's not client wise or anyone want to ask any question wise, right? We actually can do active discussion in this SG Telegram group. We can just scan this QR code to find out more.
So the
So we don't
Telegram is
just
called
talk about
SG Trading Group.
yeah, we can discuss anything, not just Singapore market. We talk about US market, we talk about EV cars, all this. So it's open to join,
Alright.
not just really one can join. Okay.
Including REITs also lah, is it?
Yeah, REITs wise, definitely you can ask inside. Anyone can ask any question inside. We can do active discussion.
Okay, thanks, Mike, for your presentation. Okay, I have one question here from Caden. You mentioned just now because we are expecting the interest rate to maybe start increase after the pandemic is over. Do you think it's not good for REITs?
Okay, that's why just now we actually do mention for REITs wise, yes, they on the whole borrowing cost will actually definitely go up. But next thing is that we look how much of their debts is actually on fixed borrowing costs. In case they are actually fixed on borrowing costs, right? Then actually, let's say I have 90%, then the rest 10% wise, they are not going to actually affect the borrowing cost of these REITs significantly. And also with a strong sponsor wise, they're able to actually borrow at a lower cost. So they may not be actually affecting them significantly. So that's why you can see a risk wise, you look at a risk manager, whether they are doing in terms of fixed borrowing costs, also whether they have actually a strong sponsor and managing. Last thing is that actually when you talk about interest rate going up, means that the overall economy is actually recovering. So when economy is actually doing well also, what they can do, they also can actually do rental revision, positive rental revision means that actually they increase the rental, overall rental. Then end up actually this one will also help cover the interest expenses. Yeah, so that's a good risk manager will be able to do all these three.
So I guess you can't just depend on one factor, lah, right? You have to look at the overall factor and how they actually manage it.
Overall factor. So that's why the track record of all these risk managers. Usually when you see all these track record of the good REITs, right, you always talk about CapitaLand, Mapletree, Fraser. So you can see actually usually behind strong sponsor. Because strong sponsor wise they have a lot of asset and also the name, branding and reputation to help all these REITs to grow well. As for other smaller REITs, because of their branding reputation is not so well, you can see some of them actually do deteriorate over time, especially if you look into Lipo Mall Trust. At one point, actually, I do invest in them because of high dividend yield. Because when I started, last time before I actually come in the finance industry, wow, give me dividend 10%, wow, it's attractive. But after when I've been, time to actually let go. Sometimes time to let go, you need to cut loss.
Right. But do you think that for REITs, because of course over the long term, if they are managed well, they will continue to grow. So you reckon because if you do dollar cost averaging, and if you want to sell, for example, and the prices go high, of course you need to do a little bit of timing, right? So you have shown us that 3 different strategies. We have dollar cost, and then we have the value, and then price to book average, right? Which one do you think will be most suitable for the Singapore REITs? in general?
I would say that, okay, personally, let me go back. Okay, just now there's three factor wise. Actually, I personally prefer value averaging, because value averaging, right, they do include a bit of timing of the factor. I continue to invest, but in case the actual market side downturn, the fundamental of these REITs remains right, then I'll put in a bit more.
So
Yeah,
this one you
because
have to
this
be
one,
a little bit more active lah.
yeah, a little bit more active, because you have to see all the overall market. Let me go back. Yeah, over here. So you can see actually this strategy, right? You spend a bit more time, but you actually tend to outperform the overall market compared to a
All
dollar
right.
cost.
Okay, thanks. Now we have a question there from Sim Winky. How the income from REIT being taxed?
Okay, because for REITs wise, just now you mentioned that some of these REITs, right, you have to. I would say that this one will be actually more on accounting side. So for what we actually do when our, because of this dividend, when we actually get back, right, all this will actually be actually taxed at the corporate level already. We won't be actually taxed at the individual shareholder level. And in Singapore wise, straight away all this dividend wise, right, is actually not taxable. However, in case you actually invest into US, right, actually for this some of these US stock, right, they pay out dividend, but you actually have a shareholding withholding tax of 30%. And depend on how they actually structure the dividend payout. Sometimes because there's actually capital gain being paid out, right, this 30% withholding tax may be even higher, may go up to 40 or higher. So this one is, I would say that there's no fixed rate, because it's actually depending on how company pay out their dividend, actually whether is there any capital gain component inside.
Okay,
But
so I guess like buying stocks, like most of the dividends are already being taxed at the corporate level. Right? Yeah, same here in Malaysia as well.
yeah, so that's why I think for Singapore and Malaysia, maybe people may buy stock for dividend. But in case you want to go for growth, right, because then you actually look towards Hong Kong and US, where they actually have growth. Because in that case, their growth, right, it's not really taxable. That's why people then generally go for growth. But in Singapore, I would say that because of the tax structure and the tax haven rise, I would say that this one is actually mainly for dividend stocks in Singapore.
Okay, Mike. So if let's say I'm still new into REITs, right, and I want to use it as a income generating vehicle, which is basically passive income.
Yeah.
Do you think someone who are starting investing in REITs, will they be able to achieve, let's say, a 10% dividend over time in your experience?
10% wise, I would say that starting wise, right? Because one thing is that for 10% wise, it may not be achievable straight away. But in case you, let's say, if you actually build a overall portfolio, and actually because of some of the risks, right, they actually, if you invest over time, I don't. Let me see. I can see an example. Because we do know that actually some REITs, right, they actually do have capital gain. If you look, one of them is like example is actually Kappa DC REITs. Let me see whether I can bring up the. Still loading. Let me try.
Yeah. So
Okay. So you can see actually some REITs, right, because they are well managed, right, actually they actually grow over time. In Kappa DC REITs, right, actually if you look into that a few years ago, it's only just $1.
So I guess you have to look at the total returns instead just of the dividends, lah. Because some of the stock prices, the capital
Yes.
gains are there as well.
Yes, correct. And there's also another way to actually get higher return, means that you have to actually take a bit more risk using of margin account. I think this one we don't really cover for beginners, because for beginner wise, yeah, it's a bit more risky because when you use margin, let's say you can actually use $1,000, you can actually purchase 2,000 worth of REITs or even up to 3,500 of REITs. That's why you can actually enhance your amplify your returns, but in case actually there's market size significant drop, right, you can also amplify your loss. And in that case, in margin call, you need to do top up or you actually have to liquidate some of your existing share to meet the margin call. That's why in this webinar, we do not cover this because maybe you do not handle right margin well, it will be a double-edged sword. You can amplify your return, amplify your loss also. But some people, they do.
Since we're on the topic of margins, what kind of interest currently brokers in Singapore providing for margin?
I would say that for stocks, if you're talking about Sing dollar wise, for us it's around 2.99%. And in case you are doing, because we don't just offer stock, let's say if you are doing bonds, actually we can go as low as 2.68%. Yeah, because if one thing is that I do not have a fixed number for this because when they actually do margin, right, you also look at over portfolio, whether your shares, right, because shares have different grading, is it grade A, grade B, or grade C? So they also look at overall portfolio. If it's very all good grade A, right, definitely you will actually get a better financing cost as compared to those who are grade B and grade C. So they actually do overall look at overall portfolio. And K2, everyone will be actually different because everyone is buy different shares.
Right. Okay, we have a question here from SK Ui. I guess because banks also pay quite good dividends over time, right? So he's asking basically between REITs and let's say DBS or OCBC, which has better dividend rates?
I would say that okay, versus REITs, right? Because REITs, some of them, right, they pay dividend. Maybe some of them are paying 3%, just like I mentioned. Some of them are paying as high as 6-7%, and some even higher than that. But next thing is that we have to think note whether all these are sustainable. Okay, one thing is that I would say that for bank wise going forward, they are expect to do well because we all know that banks actually earn money from taking your money inside the bank and borrow to others. They make this what they call is actually net interest margin because they only give you, I think, the percentage is less than 1% if you're going normal saving, unless you put into certain fixed D or what. If not, it's less than 1%. Then they borrow to others. When they borrow to others, maybe charge 5-6%. In that case, when they make this difference of 4-5%, right, it's actually their net interest margin. And especially when interest rate is expecting to go up, right, bank will actually make more on their net interest margin. So it means that I would say that going forward, bank, based on the next few years when interest rate go up, right, they'll make more for net interest margin. In that case, bank may make slightly better return than the REITs. However, if a risk manager is able to match out, well, that's why I'll say that there's no definite answer to this. But in case, I would say that better and safer, in case we are talking about healthcare or data center, right, and also logistic, I would expect them to be more stable as compared to bank because bank-wise, they do have also training income and also wealth component where they do fluctuate. In that case, this one can affect the returns of all these banks. And also, let's say if COVID-19 drag on for another few years, I think a lot of businesses will actually might go bankrupt. In that case, there will be actually bad debts. These bad debts will actually drag down the so-called returns of the banks. So in that case, then the dividend may be also kept down because you know that last year, because of this, actually in Singapore, MAS actually kept the dividend payout for some of these banks. And now they are still holding. Whether they are going to continue hold, we do not know also. But I would say that banks, there will be a while they can go up more, give more, but they also can, when times is bad, they can affect significantly also.
Yeah, I said that REITs is probably easier to understand because I mean the main source of income is just rental, isn't it? And banks, they have multiple sources of income, and businesses sometimes can be quite complicated also.
Yes, correct. That's why you need to understand banks. And also, next thing is just when we talk about digital banks, there will be definitely competition in the digital bank. Everyone will be so-called how to get more money from the from us. Maybe they have to offer us higher saving interest, then in that case, this one will affect their returns also. So
Yeah,
that will
one thing. I mean, we've been previously. I mean, for the past 1 over years or so, we have been running this, and we are talking about REITs in Malaysia as well. One of the things that we don't have is actually the data center, right? Singapore has a data center REIT, and which REIT is that?
Keppel DC REIT, just now this one. This is actually a pure data center. However,
Also,
we
that's-
also have other
Sorry.
two REITs as data center component.
Okay.
this
Maybe
one-
last. Yeah, sorry. Last question. We have maybe I'm not sure whether you want to answer here because this can be quite difficult to answer, or maybe you can ask Tan Moon Hong to actually join your Telegram group, or maybe go to Stocks BNB to ask the questions. I'm not sure because here is asking about asking you to briefly comment about these three REITs, right? We have
Yes.
FLCT, MLT, and Ascendas REITs.
I would say that all these sponsor are good or sponsor of the good REITs because first one is Fraser Logistics and Commercial Trust. Just now we share about them, especially the logistics sector with the e-commerce and shipping, right? We expect them to do well. So I think
Ascendas,
so the first one
Ascendas REIT is
Ascendas REIT is actually the sponsor wise is actually CapitaLand. Yeah, CapitaLand. So Ascendas, right? Because just now we also talk about data center. This Ascendas REITs do have actually data center component inside in Singapore and also in the US. So they are not just they have industrial, they have logistic, and also they have a portion of data center business park also. So Ascendas with a strong sponsor, and they have been actually growing well over the past few years, giving around 5 to 6% returns. So I would say that these three REITs are also doing quite well. So I would say that one of the few top picks, and also Maple Tree Logistic Trust, especially with the boom in the logistics sector. I would say that out of these three, Ascendas recently is actually trading at an attractive price to book ratio. Maybe I go back to my slide first. Because our analysts do have a call. Oh yeah, just now I haven't covered one portion on the analyst report. So our analysts do have a call on actually Ascendas REITs. So they do have a target price of around 3.6. For currently it's around 2.9. I can't remember, is it 2.92 or 2.91? Yeah, it's around. So you can see Ascendas REITs is one of the attractive play that you can look out for. So one thing is
I think I saw one of your dividend yield table. You have Ascendas REITs being one of the higher ones, right? About 6% right now.
Yeah. Okay. One thing is that why they actually have a share price drop recently is actually because the Ascendas, right? Just like I mentioned, they can actually do acquisition. They do acquisition recently. They can raise money in terms of debts. Or offer preference offering to existing shareholder, right issue, or private placement. When they do private placement, means that existing shareholder don't get this opportunity. Yeah, then actually some of them are not happy. So this actually indirectly affect the REITs also. But long term wise, they're actually doing well.
So it's more of a sentiment rather than fundamental effect.
Yes, correct. Actually, they're still doing well.
Okay. All right. So, last question, Mike, for you. If I'm starting to invest in Singapore REITs, like I know you have to diversify a little bit, but how many REITs should I actually start off with?
Okay, because sometimes it may be hard to actually if your capital is limited, it may be hard to actually accumulate. Well, I only can actually maybe buy into one REIT because you also have to think of your commission sales charge. Yeah, in that case, sometimes we do have actually ETF. In Singapore, we actually have three different REITs ETF. First one is actually they do have Philip inside. First one is Apex Philip REITs. So for this REITs, right, it's not just in Singapore. They do have the Apex Asia Pacific region REITs. And next one is actually Nico AM REITs. It's actually mainly for Singapore. Then they will also have the Lion Philip S REITs. So that's why we have actually three REITs ETF that you can actually consider investing. Just now I also can't open up my let me try to open up the SGF website to see whether I can. Maybe I just try. I don't go too far. So we have actually do have the 3 REITs ETF that you look out for. So in that case, we make use of core satellite strategy. I think this one is the one, but they talk about all these REITs because sometimes we have a core, you have a satellite. Let's say I maybe use core, maybe 60% in the ETF because other than that, then the 40% are put into satellite strategy. Right? Maybe 10% into Ascenders, 10% into Mapletree Logistics Trust, 10% into Fraser Logistics Commercial Trust. So you use this satellite to enhance. So here are the name of these 3 ETF: Nico and Philip, SGX Apex Dividend REITs, and the Lion Philip S REITs. So you can make use of this, go into the core. After that, then you start to diversify some of your 10%, 20% into the satellite to enhance the return. This is another way that investors use.
Yeah. Okay. So I think we're running out of time. You know what? Thank you so much, Mike, for your presentation and also for your enlightenment on REITs today. If you guys, if you want to have more discussion with Mike, please do join him with the Telegram group or contact him, or even contact Philip Securities or Philip Capital to get more information from them. All right. So any last thing you want to say to our audience here before we end here, Mike?
I think last thing is that everyone stay safe because COVID-19 is actually quite a serious issue. It affects everyone. So that's why in that case, it's good for you to stay safe. And also, in case you have investment or you need any further assistance, just feel free to contact us or do discuss with us. Thank you for also holding this webinar.
Okay, thank you, Mike. So, guys, stay safe, everybody. We are reaching another new COVID high daily case, new record high for daily COVID cases here in Malaysia. So, please stay safe and do continue to join us in our nightly sessions. And till then, have a good evening. And Mike, thank you once again for joining us. We'll see you again.
Okay, thank you. Have a good night.